Hi and welcome to our On Investors' Minds podcast. I'm Kerry Craig, a global market strategist within our Market Insights team here at JP Morgan Asset Management. And thank you for taking a few minutes of your time to listen to what we think it's important for investors to understand as they think about portfolio construction in today's environment. Now, I'm very pleased today to be joined by Brian Lam, a portfolio manager within our private market equity group, as we talk about all things private equity related. Now, there's a reason we're doing this podcast today. We've recently released our Guide to Alternatives for the second quarter. Many of you may be familiar with our Guide to Markets product. The Guide to Alternatives is a very similar thing, but it just delves into the world of alternative assets and is really a compendium to look at the world of alternative assets and allow users to follow the trends, which we'll be discussing today when it comes to private equity. Brian, thank you very much for taking the time to join us and to talk about private equity. It's certainly a very topical thing right now. We're getting lots of questions around what's happening in both the fundraising and exit activity we're seeing in the private market. So perhaps we could start there. What's your current take on the landscape of what was meant to be a very strong year in exit activity, but really hasn't transpired to be that way?
Thanks, Karen. I really appreciate you having me on the episode. I think in terms of going into 2025, I think there was a lot of optimism, as you mentioned, sort of about the market environment in general. And actually, I guess if you think about Q1 versus Q2, they're actually played out pretty well in Q1. So I think if you look across pretty much every single major market in private equity for the first quarter, there was pretty significant, I'd say roughly 30+% year-over-year increase versus 2024. And I'd say that the biggest swing factor and what actually ended up happening was really around Liberation Day. So I think if you sort of parse together what happened in Q2 post-Liberation Day, sort of tariffs, I think that's where sort of the uncertainty sort of creeped in. So I'd say, what actually happened was people sort of sat back and sort of thought about how does it actually impact our trade flows, how does it impact our portfolios. And as a result, when that usually happens, it means that, deal processes get pushed, people sort of sit on their hands a little bit. And so I think, Q2 obviously was a much more muted activity relative to certainly Q1 and then even relative to last year. I'd say going into the second half of the year, there definitely is uncertainty, but I think people are working through it. And I'd say there's certainly some positive factors that we've seen. So for example, on the exit side, I think activity continues to be slower than it has been in the past, but there have been green shoots in things like IPOs. So I think if you're in the right thematic, we've seen some very successful IPOs placed in the US.
So we have seen some good headlines, some ideas that there are green shoots coming through, but I mean, there is that uncertainty in the markets, which is not going away, given some of the recent developments in the Middle East and especially views around inflation, but also how that now impacts the outlook for central banks and interest rates. Notably in the US, we're thinking about potentially a higher for longer rate environment now, thinking about that inflation volatility. I mean, has the use of those higher rates, thinking about leverage and use of credit, what has that done to the activity when it comes to thinking around different deal sizes? Is it all happening at the large end of town, or are we seeing a bit of diffusion across the different market cap sizes?
Yeah, so that's an excellent question. I think if you parse across the PE market, the interest rates definitely impact the larger end of the market much more. If you think about sort of what the type of deal that's done by the upper end of the market versus the mid-market. On the larger end of the market, there's much more dependence on leverage. So the higher rates obviously impact the ability for, one, people to finance their deals, and second, for people to pay the type of multiples that people are looking for in the market. I think if you step through and think about what's actually happening, what we think is the greatest opportunity in the market, in the mid-market space, one, I'd say that the businesses themselves are quite less dependent overall on leverage. In terms of the buyer set as well, the market just is much more, there's much more selection across the number of companies that are available in that set. So it's not as competitive as, say, the larger end of the market where, if a process gets launched, pretty much every single buyer will sharpen their pens and come to market and try to bid on that. Versus, I'd say, in the mid-market space, it's much often, if you think about the type of deals that are being done, oftentimes it's like a founder that's run the business for a number of years. They're looking for a PE player who can help take that business to the next level. And as such, I think it's less about, obviously price is important, but the real factors is about, who has the best skill set to actually, help this business grow better. And as a result, I think, the actual characteristics of what's enabling those deals to happen continues to happen because innovation continues. I'd say actually the impact of innovation is even more important in this day. So, firms actually have the abilities to bring digitalization tools, and ability to, bring better go-to-market strategies are really resonating with vendors that are selling businesses. And as a result, we continue to see very strong deal flow and exit activity in that market, because I'd say it's also one where, your ability to exit is also, have much more options. So you're not dependent on any one channel. Once you've bought a business like that, you can sell to a strategic buyer, you can buy to another larger PE fund. And if the IPO markets are open, you can also IPO. So I'd say like just your option value in terms of exits is quite wide. So it's a space where I'd say, if I was to take it off, it's, you basically have less competition, entry multiples are lower, and then when it comes time to actually selling those businesses, you just have a much wider opportunity set.
That's right. Those big ones have to go to public markets. They have to IPO. If you're a bit further down the spectrum in terms of size, you can sort of look for other paths out to get to those exits. And a great segue to the next question. Obviously, another thing that's been coming up a lot in the jargon-heavy world of private equity is this idea of DPI, so distributions to paid-in capital. People are looking at what is typically thought of as an illiquid asset. You're putting your money away for a number of years and realizing actually you need liquidity in this asset. There's a lot of investors who are waiting for that money to come back to them to be reinvested, but because those exits have been closed to a certain extent, they haven't seen that come through. And so this has really been an idea around, if we do see a pickup in activity on the exit side, are we hoping to see that change, or is that a feature of the market you think is going to persist for a little bit longer in terms of the challenges around liquidity?
So liquidity, I'd say, just given the uncertainties in the market, I think that tends to lead to people wanting to, basically price the deal better, which slows the activity. So I think if you think about what people are expecting going into 2025 versus what's likely to play out, I think it'll be a step below what people had expected going into it, just given the greater uncertainty in the market. That being said, I'd say the market for the right type of deals will continue to be, I think pretty attractive. So I think there'll be a bifurcation in the market between firms and deals where they really are in the right sectors, where there's growth happening and the ability to actually leverage, the ability to improve those businesses is will come to the fore, versus I guess the more traditional businesses where it's really, you're waiting for market windows, and I guess it's, financial leverage or just a financial engineering game. I think those kind of plays are probably not going to be as, you're going to find as willing of an exit market. I'd also say that when you think about sort of the flywheel of private equity, is I think the way you put it is actually right, in the sense that the model historically worked where you had money that was invested into for a multi-year period, you improved those businesses, you brought them to market, you sold them, and that money was then recycled back into the next fund. That cycle and that flywheel has been disrupted a little bit because historically, I'd say funds typically would raise their next fund when they've approached probably 70% invested, and normally you'd probably also have a decent amount of that capital also coming back via the form of exits. But now, I'd say the deal environment is still pretty receptive to, if you want to find attractive deals, you can find them. But the exit market is a little bit tough. So the flywheel of, people continue to invest their funds, but not able to deliver money back to their investors, which is then slowing the investment pace or ability for them to fundraise for the next fund. So I'd say it's a market where I'd say if you have capital, it's a great place to be, because there's less competition chasing those deals, which means that the underlying transactions, you have more time to actually spend time on them. You don't have to pay as much for them. But at the same time, if you're trying to fundraise, it's a tough place to be, because your investors that are relying on that money coming back from their past investments are essentially just waiting for that.
That's the way that I think about it, is that if you're a provider of that liquidity, if you have that capital to put to work, there's a lot of opportunities in this space. And it has given rise to another big area, which is private equity secondaries. So we obviously think about private equity primaries. We invest in those companies or those funds for a multi-year period. It matures, we get our money back, as you mentioned, that flywheel of it going through. But now, because of this need for liquidity, the companies, whether it's the general partners or the limited partners, are now sort of wanting to sell that to create those distributions. So let's talk about private equity secondaries. How big is the market? What's the growth there? And what's the opportunity for you as a portfolio manager?
So the private equity secondaries market is one that I think is probably one of the most interesting areas in the private equity market today. I'd say just if you step back, the private equity secondaries market is essentially, the addressable market is deals are invested into call it 3 to 5 years ago. So if you think about just the growth of private equity period, leaving aside all the liquidity issues today, that market would have already been growing pretty tremendously just by the fact that if you go back 10 years time, the private equity market in, say, the US as an example was roughly about $500 billion a year. Today, it's closer to $1 trillion. So you've already doubled the market in about 10 years' time. But if you layer on the fact that liquidity is tougher now, you're basically adding on the fact that you have a much larger addressable set of deals, as well as the fact that the addressable percentage of those deals has also grown just because the need for liquidity is higher. So I think the backdrop itself in terms of the size is already pretty attractive. And then I'd also say if you think about sort of the capitalization of the secondaries market, it's a very undercapitalized market today. So to give you some stats on this, the market for private equity secondaries, total transactions last year was roughly $180 billion US. And then the dry powder to actually support that it's roughly in the same range. So you basically have 1 times dry powder to annual deal activity, which is a very attractive place to be. If you use the comp for the private equity markets, say the private equity funds, for example, that ratio was closer to 3 to 4 to 1. So you essentially have 3 to 4 years of deal activity in terms of dry powder that's sitting there. So, I think it's a really attractive place because one, the opportunity set's increasing, 2, the amount of capital to actually do that in a market where the need is only growing is very attractive. So we're finding a lot of opportunity in the market just given the fact that I think the amount of deals that we're seeing coming across the desk every day is very high quality and very good. And secondly, I think just the fact that we are also primary investors enables us to have an advantage to be able to price those deals because we have informational advantages around understanding those portfolio companies, being able to leverage relationships that we have with the private equity funds who we know very well. And if we want to pick up the phone and ask them for their views on any of the portfolio companies, we can do that. Whereas someone who is not an investor will be relying on basically pricing things on an outside-in basis, which on the secondary space, I think it's a pretty big advantage to have because at the end of the day, I think people talk about discounts, the actual pricing of a position, but we think of it as a bottoms-up pricing because different GPs will mark their portfolio values differently. Some are more conservative, some are more aggressive, but we try to cut through all of that and try to understand what the fundamental value is, which you can only really understand if you understand the portfolio from a bottoms-up basis.
So you have the opportunity both in the primary market, you're thinking about the secondary market, you're thinking about, I guess, the more small to mid-cap range where there's more exit opportunities, where there's less competition, as you mentioned, from a lot of the players because there's not so much dry powder there trying to drive down prices. And again, the question I was going to ask you next was how do you think about what constitutes a good deal in the secondaries? But you've kind of already answered that. It's having that network and understanding what the value is if you're looking at it versus the primary market and having that benefit of that insight and that research on that basis relative to someone else who doesn't have that activity on the primary side as well. And so that leads me just to, I guess, the third pillar when we think about private equity. So primary, secondary, and that's co-investments. So again, being a provider of that liquidity, being someone who can step in, again, when there's higher interest rates, less use of debt, greater need for capital, and maybe others are stepping back because they don't want to allocate so much capital to these deals and being able to step in. What are you seeing on the co-investment sides? And perhaps you could maybe quickly say, what co-investment actually is relative to the primary and secondary market.
Right. So the co-investment market is one where you directly invest in a deal alongside a GP. So we call it a co-investment because you're supporting a general partner as they're actually investing into an underlying business. So rather than investing in a fund, you're investing in a company. I'd say in terms of the market for co-investments, it's one where because capital is such a valued resource in this market, having the ability to support GPs as they're actually going out and finding deals is, I guess, the opportunities that we've seen in just a very large increase in the amount of deals that are coming from our existing GPs as well as new GPs in the market because, one, I think they actually want capital to diversify across, when they're spreading their bets across their funds. So it allows them to not put all their capital into the one deal and such. I think we're just seeing increased stability from, I'd say the biggest one is people outside our network who are actually reaching out to say, we have this really interesting deal. Could you help us underwrite this and come in? So for us, it's a pretty attractive space because one, you just have a better ability to underwrite the individual deal, which in a market where liquidity at the overall portfolio levels is slower, if you, as I guess I was talking about previously, if you're in the right thematic area where the exit options are open, it reduces the J curve, right? So we're finding the deal quality on the individual deal level to be quite high because people have all raised their bar internally for deals that actually get across the line for their portfolios. So we are able to put another layer on top of that to also diligence the deals ourselves. I think the quality of the deals that we're seeing in our portfolios is very high at this point in time. And then I guess the other factors around liquidity, reducing sort of the exit windows, it also is pretty positive in the sense that I think we're seeing pretty thematic investments in areas that are less cyclical. We talked about trade wars and sort of the impact of tariffs. I think we're able to take all this stuff into our underwriting. So we're finding businesses that are less exposed to some of these areas, or they're just less exposed to policy risk. So I'd say you probably have a more attractive backdrop in terms of the characteristics of the business, as well as the ability for you to really underwrite a value creation thesis where you're bringing to bear pretty strong drivers around sort of growing businesses internationally, domestically, across segments, and also just improving the profitability of the businesses, which I guess in this environment, if you're able to do that, when it comes to exit, if you have a strong growing business that's profitable, it's a great place to be.
Yeah, so it's much like similar to the secondaries market. If you think about co-investments, you're, I guess, shortening your investment horizon because you're getting in a little bit later. That J-curve effect, you're not experiencing so much because you're avoiding the initial drop at the first part of the investment and thinking about getting your return back a little bit quicker. And at the same time, obviously having a better read-through to the performance of the underlying company, given that it's been a going concern for a while, or the underlying portfolio companies if you're thinking about investing in a fund on a secondary basis. So again, I guess it comes back to a lot of the messaging we have around the private markets and public markets being similar. It's that focus on quality that really is the driving force there. Brian, thank you so much for your time today and walking us through what you're seeing in the private equity space. As I mentioned, the Guide to Alternatives is out if you would like to see a lot of the data that drives these conversations that we have and the charts behind it. You can find them in the Guide to Alternatives that's on our website. If you'd like to know more about this, please reach out to your JP Morgan client advisor. Thank you for your time.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks, The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.